Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis welcoming you to Money Talk for Tuesday, April the 18th. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China's central bank left its one-year medium-term lending facility operation unchanged at 2.75%, the eighth month in a row for it to stand pat. It made a liquidity injection for the fifth month in a row. PBOC made a fund injection of about $20 billion in April, the smallest since November. Three big US financial groups, Charles Schwab, State Street and M&T, suffered almost $60 billion in combined bank deposit outflows in the first quarter as customers continue to move their money in search of higher returns. Adding to the pressure on mid-sized lenders, Apple and Goldman Sachs on Monday announced the launch of a new savings account in the US that will pay a market-leading 4.15% a year. That's more than 10 times the national average rate. Companies have committed more than $200 billion to US manufacturing projects since Congress passed the Inflation Reduction Act and the Chips and Science Act last year. These laws provide sweeping subsidies to companies as the Biden administration seeks to break US dependence on Chinese supply chains. And Singapore's non-oil domestic exports shrank 8.3% in March year-on-year, though the drop was smaller than the previous month and was less than forecast. On today's Money Talk, we're joined by Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Sam Faveur, CEO at Mandarin Capital, and our US economics correspondent, writer and broadcaster, Barry Wood.
Peter Lewis's Money Talk.
On Wall Street, US stocks rose Monday following a mixed bag of earnings as the first quarter reporting season gathers pace. Bank shares led the advance while a slide in Google kept the Nasdaq in check. The S&P 500 rose 0.3% to finish at 4,151. The Dow gained 101 points, or 0.33%, to end at 33,987. The Nasdaq also added 0.33% to settle at 12,158. Shares of Google parent Alphabet fell 2.8% after the New York Times reported that Samsung is mulling ditching Google's search for Microsoft's Bing as the default search engine on its devices, threatening about $3 billion in annual revenue. And three big US financial groups, Charles Schwab, State Street and MAT, suffered almost $60 billion in combined bank deposit outflows in the first 3 months of the year. Shares of State Street fell 11% after it reported deposits fell 5% in the first 3 months of the year. That helped drag the KBW Regional Bank Index down 0.5%. Chinese markets advanced with the Hang Seng adding 344 points or 1.7% to an 8-week high of 20,782. And this morning, the Hang Seng Index is projected to open 154 points lower, that's about 0.7%, at 20,630. On the mainland, the Shanghai Composite rose 1.4% to 3,386. That's a new 8-month high. Elsewhere in the markets, US Treasury yields and the US dollar rose, while oil prices saw the sharpest fall in a month. And you can get all the latest market movements in my daily newsletter, which you can find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Time to welcome our guests. We have with us Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia. Morning, Mark.
Good morning, Peter.
And also joining us, Sam Faveur, who is Chief Executive Officer at Mandarin Capital. Nice to see you again, Sam.
Morning, Peter.
And also with us in Washington, D.C., our regular Tuesday correspondent, our US economics correspondent, writer and broadcaster, Barry Wood. Morning, Barry.
Good morning, Peter.
Let's start with China. It's going to be an important day for economic data today. We've got first quarter GDP coming, industrial production, retail sales, fixed asset investment, all being released later this morning. China's central bank left its one-year medium-term lending facility operation unchanged at 2.75%. Yesterday. They made a net liquidity injection of about $20 billion in April. That's the smallest since November. And it marks the 5th month in a row for the central bank to take such action. Mark, perhaps you want to kick off. As mentioned, it is going to be a big day for Chinese economic data. But looking at what they did yesterday suggests that Beijing's not particularly worried about the recovery of the Chinese economy.
No, and that's the message that they're sending. Barry was on RTHK yesterday talking about Yigang, central bank governors, various speeches in Washington, including to the IMF and World Bank meeting and to the Peterson Institute and so on. And he seems to be pretty confident that there are worries, and of course laid out all those worries, but things seem to be in hand. And he said they have the twin pillars of pursuing price and financial stability, and he aims for a inflation-adjusted interest rate to average slightly below real economic growth over the next few years. Now, if he can achieve that, that would be quite an achievement. But there is quiet confidence in China's economy this year, maybe misplaced to some degree, including among many of our members of our forum group.
Barry, what did you make then of Yi Gang's speech? He was pretty upbeat, wasn't he, about the prospects for China? He thought the woes of the property sector were under control, the financial sector was under control, all the major drivers he seemed pretty positive about.
Yes, I think that's true. And, I don't want to be an apologist for the central bank chief, but this is a very erudite, smooth operating person who seems terribly candid. And, I think that the property problem that was so much in the news over the last 12 months, he expresses no outward worry about that. He didn't suggest it was resolved, but it's certainly something that he regards as under control. In terms of the internationalization of the renminbi, he's relaxed about that. He said people and government should be able to trade in whatever currency they wish. He said some things that probably were eyebrow raisers, saying that, China doesn't intervene in the markets to protect the renminbi, but of course it does from time to time, but less so than it used to. But anyway, that was very impressive, and I think that he sees China at 5% economic growth or more.
Sam?
Can I just make one comment? It's the same thing. I went on an American Chamber delegation to China, 15 years ago or so, and Yigang was one of the deputies. And he said exactly the same thing about the free convertibility of the renminbi. He said, I don't have a date, and he said it again this time. He said,
yes, he did.
It's not going to be tomorrow, and that's a time when people were saying it's 5 years away or something like that.
But if they were to do that, if they were to allow the convertibility of the renminbi, which is an absolute essential precondition, isn't it? If it's going to be used more in trade and international finance, the government's going to have to give up control of the economy at the same time.
Yeah, it's a big deal, and they feel, and Sam might have different views on this. I think they feel that that's been reasonably successful over the past few years, including during the financial crisis.
Well, I think for the central banks, there's two different aspects. In terms of forecasting crisis, the track record of central bankers has been pretty poor. So, saying that for the central bank in China, I think they have a decent environment. They also have a very narrow path because they still have, inflation, which is creeping up. They still have those credit issues going there. So they can't really go one way or the other. But they are lucky at this stage to have the recovery. And, they have the time to wait and see. So that's the positive side of it. Now, looking forward, I think they're projecting a level of confidence because they obviously want to internationalize, but they still have a lot of domestic issues to sort, especially maybe not the real estate crisis, which seems to have abated a bit, but they have a lot of local SOEs and local governments to deal with, especially after the the COVID crisis. So at some point that will have to be dealt with, and how they will deal with that will also have a huge impact on the credibility of, as you mentioned, the monetary policy and the yuan internationalization.
We had some pretty mixed data, though, didn't we, last week? Probably the most surprising one was that trade data, the export data, which really surged. What was it, about 15% last month. And then when you compare that, when we've had trade data for the same month from South Korea and Taiwan, their exports have plunged. So it's even more surprising, isn't it, that China seems to be doing so well when everything we hear is about the global economy slowing down. Sam?
Well, there's been some reallocation of trades. I mean, there's been some compensation with other regions. I mean, obviously, China has been trying to rebalance its trade, not only with the classic partners, but also, with the likes of Russia and the Middle East. So I think we start seeing some of these effects. So there's cyclicality. So let's see how things goes up. But it has been fairly resilient, to be fair.
Barry, I wonder, though, how much of these exports that China is doing, which seems to be going mainly to Asian countries, places like Singapore, Indonesia, Thailand, how much of that, though, is ultimately being re-exported to the US? So it's really US exports, although they're being disguised a little bit through other countries.
Well, that may be true. Look, I think we've got a port problem in the West Coast. And I don't think that there's anything that would suggest that there's a lessening of the United States' dependence on Chinese goods. So if they're coming in from third countries, so be it. The reality is that the administration here and business to a lesser extent can look for lessening the dependence on China, but I don't see it really happening quickly. And I don't really see it happening even slowly.
And that's interesting because we're hearing a lot. We heard it at the G7 foreign ministers meeting in Japan over the weekend. The main priority for the US and for the Biden administration seems to be to reduce its economic dependence on China. But then when you look at the trade data between US and China, it's at a record high. So it doesn't seem to be working, does it?
Yes, you're exactly right, Peter. Look, this business about Apple and India is interesting. But when you look not very far down in any paragraph written about this, the initial moves by Apple in India is to open stores. Mm-hmm. That's very different from an assembly plant. Now, I know they would like and plan to do assembly plants, but that takes longer.
Mm. Mark, what do you make of this effort by the US to try and reduce dependency on China?
Well, it's interesting. They were in Kuroizawa, which is one of my favorite places in the world. A lovely resort town in Japan. But it's interesting that Secretary Blinken was with the French foreign minister and with the German foreign minister, as you say, trying to make this point, which is a little bit in contrast to Macron's visit to China and what he came back saying, and the Germans, not so much what they said, but what they're actually doing in terms of the relationship with China. As Barry said, the relationships are too close and they're too intertwined. There are ways of lessening them to some extent, and many companies are trying to diversify to a degree, but at the same time, most of them are remaining in China, and some are actually increasing investment. That could change if the geopolitics and other issues get more in the way than they are already. But at the moment, that's what it is, and the issue is they can't raise that publicly, because then you get in a lot of trouble, especially in the United States.
Well, let me quote what German Foreign Minister Annalena Baerbock said yesterday at the conclusion of the G7 meeting. She said Germany wouldn't compromise on its values when it comes to engaging with China. In a response to a question on Taiwan, she said that Europe won't look away if international law is violated. She said, I made it clear in China, we want to cooperate, we want to be partners, but we're not naive. So, Sam, this is a different message, isn't it, from what Emmanuel Macron was delivering when he was in Beijing, what was it, a week or so ago? What is the European position?
I don't think there is a European position, so that's the problem. So there are multiple positions. Macron obviously has his domestic problems, so he's trying to build an image of himself, being a leader and trying to diversify away from the general view. So I think that's more a domestic issue. But the fact is there is no European view. And the reality about, the supply chain, it's something which started 25 years ago. It's a very, very long-term thing. So even if we see decoupling, we're going to see that over 25 years. And if you're a CEO of a multinational, really, it doesn't matter what the G7 is going to do, is going to say. It's what the shareholders are looking at. And at the end of the day, it's money versus risk. And at this moment, if China makes the message and is people feel confident to stay in China, they will stay in China, whatever the G7 or the US are going to say.
I was just at a China strategy meeting in Shanghai, which I think I mentioned last week, of our members. About 100 companies were there. And the message was on supply chains is that it's generally eased, not for everyone, but at the same time, much happier than they were a few months ago in terms of their ability to get products and semiconductors and so on. That may change. Of course, it could change very quickly. But at the same time, again, the cautious optimism was there, but also looking around the corner and not so sure what's going to happen. And the various other problems that we've been talking about that Sam's raised and Barry's raised were at top of mind as well.
Barry?
Let me just add the trivial element of Mr. Macron's visit. I was delighted to come across this video of how he was cheered on the streets of Guangzhou. I mean, people wanting to touch the French president. My goodness. Here you are in the greater Bay Area. I wouldn't have thought this would happen. But then he gets back to France and they're still in the streets. What a contrast.
But they were rather carefully selected participants, weren't they? They weren't just people who happened to have turned up off the street.
I see.
Let me ask you, Barry, about what the IMF warned last week. They warned about carving the global economy up into these competing geopolitical blocks led by the US and then another block led by China and its friends. What do you think is the risk of that happening?
Well, I think it's a significant risk. The problem is for the fund that China is a rising power in terms of the voting shares. Now, the United States and Europe dominate the fund, and they will for some time. But any forecast or any analysis takes into account that China needs to approve that. It's not as bad as, say, the OECD, where countries actually have a veto on what the organization can say about that country. But I think the fund is very careful. As to the reality of the world dividing into two blocks, I don't think so. I think the Asian countries, and of course you gentlemen are much closer than I think that they want to do business with both sides. Certainly the Japanese feel very strongly that you don't want to risk the relationship with their number one trading partner, China. And that certainly is replicated right down all the way to Singapore and beyond. So in the United States as well, there's a lot of political rhetoric against China, but the business relations remain very strong. I think the fund had to say that and had to point out the danger of it, but I don't see it happening. I think that the world will find a way.
I was at the IMF meeting in Hong Kong yesterday talking about that report. And clearly one of their concerns, they didn't necessarily say it, but the implications were there, is of course for the role of the IMF itself in such a world. And I think they're having problems, as everyone else is managing the COVID world and what that means for their authority and how they can balance the various interests, whether it fragments completely or semi-fragments, at least there are rivalries. So I think that's one of the major issues as well.
Sam, if a split were to happen, maybe it's not likely, but let's suppose it did, it's pretty disastrous, isn't it, for the global economy? Wouldn't it lower global trade and growth overall if that were to happen?
That would. We've seen that historically. Now, I don't think it's likely to happen. I mean, as Barry and Mark mentioned, we're too intertwined at the moment. It's just too much to lose. But at the same time, we have those growing economies in Asia, now becoming the number one global economic force in the world. So I think it does make sense that they are advocating for higher power and a higher saying in those international institutions. So if you look at the dollar and you look at all these institutions which dates back to Bretton Woods, there needs to be some evolution. So people, I mean, it's the politics at some point, they need to be smart enough and sit down and make it evolve. Otherwise, there will eventually be a split because, it's, to be fair on their side, it's fair to us.
Mm. Now, companies...
That's the course I teach.
Sorry, Mark.
It's a course I teach at Chinese University exactly on that issue, and I couldn't agree with Sam more. It's just a question of how they're going to do it because they keep talking talking about it. But as far as specifics, we haven't really seen much yet. At least that's agreed on by a lot of people.
Now, companies have committed more than $200 billion to US manufacturing projects since Congress passed the Inflation Reduction Act and the Chips and Science Act last year. These laws provide sweeping subsidies to companies as the Biden administration seeks to break US dependence on Chinese supply chains and spark a new industrial revolution in the US. Barry, perhaps not all of our listeners are familiar with the Inflation Reduction Act, which, if I'm correct, has nothing to do with reducing inflation, and the Chips and Science Act. Maybe you could just explain a little bit about what these two acts are and what they're trying to do.
Well, I would put it, you're absolutely right about the name of that. It's the most atrocious name possible. And, it is probably going to boost inflation, not reduce it. But it's industrial policy. That's what we're really talking about. Mm-hmm. We're talking about the United States reverting to a kind of policy that wasn't completely discredited 20, 30 years ago, but it was rejected by administrations, mostly Republicans in this country, that used government priming of a pump to get the private sector involved. Mm-hmm. I think you could make the case that in high tech, this is a very useful thing. But the Europeans identify what's happening in the States very clearly. They see it as saying, wow, you're excluding us, and you're also excluding the Asians, but you're doing it yourself. So this may violate World Trade Organization rules. Now, to answer your question, one section of it is just the CHIPS Act, which at least does address the semiconductors, and that's to throw a lot of government money, in fact, a huge, unprecedented amount of tens of billions of dollars to promote the construction of fabrication plants in new generation semiconductors. As to the broader analysis of the other act you mentioned, the IRA, the Inflation Reduction Act, which is the industrial policy component or one component of the two, I think that it's just a real hodgepodge. It includes all kinds of social programs in that, but I'm not really going to be able to answer your question with precision, Peter, because I haven't looked at it in a few weeks, but it throws a lot of money to start things up. It primes the pump in lots of different sectors.
And it seems to be working in some ways because, as I mentioned earlier, a lot of companies are grabbing these subsidies. I suppose that's what they have to do, don't they? If they're on offer, they've got to take them.
Step forward at once, but you've got all kinds of regulations and all kinds of restrictions that have to be met before they can really get a hold of the money. So yes, it may seem to be working, but I would say it's very early innings.
Mark, is this just another form of protectionism?
In a way, because the U.S. is trying to find a way to compete going forward, because they see China and actually even the EU and others as being much more formidable competitors than maybe they thought they were a few years ago. But industrial policy, as you know, as Barry knows, has not been particularly successful in the U.S. in previous years. Not only they stayed away from it, when they tried at government getting involved in the economy, like Hong Kong government, as a matter of fact, has had a very mixed picture. But at the same time, it is definitely America First policy. Mm-hmm. Biden, he doesn't call it that often, but that's what the Trump administration said, but it's certainly what it is. And so what's happening, as you pointed out, is several companies, international companies, are investing more in the U.S. to try to take advantage of some of these as well, which is interesting.
Mark. I think you've got it right. And the answer to Peter's question is, yes, it's protectionist. Not overtly so, not way over the line, but it is protectionist.
Sam, what do you make of this? Now. Because if America has been made big criticisms of China for its sort of industrial policies, the way it supports state-owned enterprises and so on, but isn't it just doing the same thing itself here?
They are doing the same, and also it's not going to solve the issue, because if you look at what advantage people are looking at in China is the whole integration of the supply chain. I mean, you have from rare earth processing, and if you're trying to do anything in China, you cross the border and within 20 miles you can manufacture virtually everything. So they have from the very bottom to the top processing, which you don't have in the US. This is purely targeted. on semiconductors, which is strategic, but that's not going to replace the dependence. So I think this protectionism is going to be completely inefficient. And, it's also very easy to blame China. But when you have, as I said, like a rare earth processing plant, which is extremely polluting, at the end of the day, none of these developed countries wants to have it on their ground. So, but it is core to the world economy. So at the end of the day, you have to make a choice. And at this stage, they're just blaming, but they're not ready to take on their responsibilities if they really want to decouple. So it is bound to fail.
It reinforces what Sam says. Our forum members keep talking about the ecosystem, and that can be defined in a lot of different ways. But how the China system is, works. It's not perfect. There are flaws in it, but compared to other places in Asia and maybe other places in the world as well, and it's not easily replaced or replicated.
What about the US, Barry, on the green sort of sector? This is one of the sectors, isn't it, that the Biden administration has prioritized. It wants more investment in, and it's trying to encourage companies to invest there. That's where some of these subsidies are going, presumably, from the various acts.
Peter. This is why the Democratic-sponsored IRA, which has far more money than the CHIPS Act, that is the one that many people in the environmental community hailed it. But that's because it was done with stealth. No one knew what was in it. No one knew what these massive numbers really meant. But it does address the greenhouse issues that are at the forefront. So let's see how that turns out.
Well, in the few minutes that we've got left, let me return to China, because we have got that economic data coming out in about 2 hours' time. Let me ask you all a question. How much is China, in effect, staying afloat and supporting its economy by just flooding its markets with cash? We saw those credit data. Credit expansion is much better than expected. In fact, for a month of March, it was a record sort of high. There's been a big spike in demand for mid and long-term loans for housing. We've seen funds go to industrial projects, more bridges and railways. Is China reverting to type here and just trying to boost credit to drive its economy?
I think. Well, yeah, they still have been using the same old trades, which is infrastructure. But at the same time, they have what is really going to be the key driver for the Chinese economy, to have this domestic consumption continue to bounce back to pro-COVID. So I think it's not necessarily the government pushing, but you also have demand driving those numbers. So that's really what is going to be important to see in the medium term, that continues to go up. So I don't think it's purely policy induced. I think we are seeing some domestic rebound. So let's see what the numbers come up with.
Mark, what do you think?
Yeah, I'm really looking for the same reasons. I'm looking forward to these numbers. They're not going to be decisive, of course, but at least they'll give an indication of the direction the economy is growing, because, again, we've got mixed signals. Maybe you saw it, The Economist now has a new term, and they call it the Mona Lisa post-pandemic economy. Each time you look, it looks like something different.
That's very good.
I think that could apply to China and much of the rest of the issues that we're looking at right now. But I think we're going to see some movement, especially on the domestic side, which is key for China moving forward. Both the government says so, and I think that's true from an overall economic standpoint.
But Barry, I'm wondering how much the US and China can be following totally different sort of monetary policies and policies on sort of credit growth, where you've got the US tightening, you've got them sort of reducing support for the economy, raising interest rates. You've got China doing the complete opposites. They're lowering the cost of funds. They're flooding the markets. You've got companies borrowing new money to go and refinance existing debt. In a more globalized economy that we have now, can this continue?
Well, I think your characterization is correct. And I don't know how long that can go on. Look, the political factor is critical. And I was reading somewhere that the Chinese government is reluctant to have Mr. Blinken, the Secretary of State, come to China if the Americans disclose more about what was in that balloon. And so we'll see how that plays out. And now you've got the day's news here in Washington is that there's been some Chinese arrests in New York City about policing. So, the political factors are dominant and the signs are not good.
Do you think, Sam, China can go back to the days where it really pulled the global economy forward? I mean, we saw that after the global financial crisis. Can it do the same again?
I think they're in a good position at the moment to be the main driver, and they can still work, as you said, the decoupling of monetary policy, first of all, because they control the yuan. So it's a lot easier for them to control the overall monetary policy. So I think at this stage, they probably have a lot of more leverage to play around because they have benign inflation. As we mentioned earlier, the credit issues are for the time being under control. So they can really be the leading driving force for growth, at least regionally for the time being.
What do you think, Mark?
Yeah, I think they're the main game in town, as they say at this point, mainly in comparison to the U.S. and part of Europe, at least for this year. So I agree with Sam, and I hope it happens because we need a little boost.
Yeah, I think that's exactly it, and it's going to be the headline that says China is back, and that will be with us, I think, for several more months.
Mm-hmm. Well, Barry, let me give the last word to you. President Lula da Silva of Brazil, he was in China last week talking about emerging markets replacing the dollar in international trade and finance with their own currencies. He wants to reduce the dependency on the US dollar, which of course is music to President Xi Jinping's ears. What do you make of what he was talking about?
Well, I think Mr. Lula, who is on the left, as some listeners would be aware, and he's come back for a second time in Brazil. Brazil's had a terrible time in the last 10 years trying to make its economy grow faster. I was at the first BRICS meeting. That's Brazil, Russia, India, China, South Africa, in Durban in 2013. The organization has faded in its importance, and I think Mr. Lula wants to bring it back. And it's a cheap shot for anyone in the world to say, let's go after the dollar. We don't like the dollar and the Yanks to be dominant. It's not going to happen, not with the BRICS. But, of course, what sanctions have done against Russia is force Russia and China closer together, and they're settling their accounts in renminbi.
I mean, I'm wondering what the Biden administration makes of it, because Brazil's traditionally a US ally, isn't it? But here he is, in a competitor country, basically calling for the replacement of the US national currency.
Well, I think probably the Biden administration, the cooler heads, will regard what Mr. Lula said in China in the same way they regard what Mr. Macron said in China. You can say all that you want, but it's not going to change very much. And I don't think the friendship of both those countries to the U.S. is going to change.
Okay, well,
I agree.
Thank you all very much. Great to hear your thoughts this morning. You heard Barry Wood, our US economics correspondent. He's over in Washington, D.C. Sam Faveur, who's Chief Executive Officer at Mandarin Capital, and Mark Michelson, who is Chairman of the Asia CEO Forum at IMA Asia. Thank you for listening this morning. If you have any comments on the show or questions for our guests, then please email me. My email address is peterlewismoneytalk.substack.com. On tomorrow's programme, I'll be joined by personal wealth advisor Enzio von Pfeil and Hong Kong-based macro strategist Patrick Bennett. And with a view from Japan is Nick Smith, Japan strategist at CLSA. See you tomorrow.
Money Talk